In today's episode, I'm going to teach a masterclass on how to use technical analysis to become a better trader. I'm going to share with you the indicators that I use every single day. I'm going to teach you how to read candlestick charts, and I'm going to show you the candlestick chart patterns that I think have the highest probability of success. Remember, everything I share with you comes from my own experiences trading the markets. My name's Ross Cameron. I'm a full-time trader, and I'm probably best known for turning an account with less than $600 into more than $10 million of verified and audited trading profits. Although those results are not typical, my experience puts me in the unique position to be able to share with you what is actually working in the markets today. At the end of this episode, I'm going to give you some recommended reading so you can continue your education. I'm also going to share with you a PDF of my own small account strategy that you can download, print out, and use as a resource as you are improving your own strategy. The goal of this class is not to teach you everything that I know about trading, because there's no way I could do that in less than an hour. The goal here today, instead, is to teach you the most fundamental concepts that you need to master in order to find success, and to give you some skills and some techniques that you can implement in your own trading today. If you find this helpful, I hope you hit the thumbs up. I hope you subscribe to the channel to get regular weekly uploads just like this to help you become a better trader. Now, one of the first things I want you to understand is that we use technical analysis and chart patterns in an attempt to predict what the price is going to do next. The traders who predict it accurately will make a lot of money. Those who don't will lose. So naturally, we have high stakes in making an accurate prediction. And that's why traders are so obsessed with finding the best technical indicators and learning the best chart patterns that have the highest degree of success, because we don't want to lose. We all want to have high accuracy. Now, I can tell you that every single day on chart patterns for pretty much any financial instrument you could look at, there are buy and sell signals, because this is a universal language of the financial market, and it is well respected by millions and millions of traders all around the world. If you do not yet see those buy and sell signals, it is just because you haven't learned to read the language yet. But that's okay. That's what this class is for. Now, in the older days, we didn't have traditional chart patterns like we have today. What people actually did was, from the Wall Street Journal, they would take the price of stocks, which would be the closing price, and they would just put it on basically graph paper to create their own rudimentary chart patterns. But they did this because it felt necessary to understand the context of the current price, because that's what these charts do. They give us context. If I say, hey, here's a great looking stock at $5, that doesn't tell you a lot. $5 relative to what was its all-time high? What was its all-time low? What has it been doing recently, right? We need all of that to better understand the context. Now, traders who get really good at technical analysis and really good at reading chart patterns are able to do something pretty incredible. We can visualize half of a pattern. We see half a pattern, and we can visualize the pattern resolving the way we would expect it to. So it's almost like we're completing the picture. When we look at the chart on our actual computer monitor, we're seeing only half the pattern in real time. It's only as it resolves that the full pattern becomes complete. So the better you get at being able to recognize these patterns when they're in their earliest phases, ultimately, the more money you'll make. Now, right now, far and away, the most popular type of chart pattern, or the most popular type of chart, is a candlestick chart. The reason candlestick charts are popular is because, in contrast to a line chart and those sort of old rudimentary charts that traders made in the old days, a line chart only gives you basically one piece of information. It's the closing price of the stock. Closing price, closing price, closing price, closing price. But that doesn't tell you anything about what happened during this period of time. This is the closing price of this day. But what if the stock happened to go up, I don't know, like 100% and then came all the way back down in that one day? You wouldn't know any of that from just this one dot on a chart. So line charts are completely inadequate for really communicating context around price. They're useless. We don't use them today. What traders today use, including myself, are candlestick charts. Candlestick charts get their name from centuries ago. They were used in Japan for rice futures, and they gained popularity because they're really incredible charts. The reason that candlestick charts are so special is because each individual candlestick communicates 4 pieces of information, and they create this visual representation. The shape of the candlestick is created by where the stock opened and closed and its high and its low during this period, but that visual shape communicates a message. So it really is, it's almost like each of these candlesticks are letters of the alphabet, and when the letters are combined, they are either spelling one of 2 things: buy or sell. All right, so let's break down the anatomy of an individual candlestick. And I'll actually do it on the whiteboard because it's a little bit easier. So a candlestick communicates 4 pieces of information: the open, the close, the high, and the low. All right, so what does that mean? So when a candlestick opens, that means that trading has begun. So let's say the market opens at 9:30 a.m. Eastern Standard Time. That's when the opening bell rings on Wall Street. So at that moment, a candlestick opens. A stock opens at, let's just say, $4. That's the open. All right, so now we have our first piece of information. Let's say initially the price goes down to 390, goes down to 390. Then, and in this moment right here, the shape of the candle would look like a T right here. Now, this is actually somewhat ominous candlestick shape because it shows that the price is declining. All right. And then let's say the stock squeezed up to $4.50, which would be a really nice move. And then let's say at the end of the candlestick period, it closed at $4.40 right here. So these are our 4 pieces of information. We have the low, we have the open, the low, the high, and the close. And we always connect the body around the open and the close. So the top here becomes an upper candle wick, the bottom becomes a lower candle wick, and the body of the candle is typically filled in. Now, some people on their charts will have hollow body candles, and that's fine if that's what you prefer. It's sort of a visual preference whether you want to have the candles have solid bodies or hollow bodies. Some people who have color blindness will actually have all the red candles have whole bodies filled and the green candles will have hollow bodies, so it's easier to differentiate red and green. But for those that don't have that issue, we usually just leave the candles fully colored because it's easier to see that. It's very clearly green when it's filled in. So this is one candle. Now, if we were looking at a stock chart that was a 5-minute chart, then every 5 minutes a new candle begins. So this would be 9:30 to 9:35, 9:35 to 9:40, 9:40 to 9:45, 9:45 to 9:50, and so on and so forth, until we have a stock chart that is completely filled with hundreds of candles to complete the day. Now, in terms of time frames, the most popular time frame for active trading is 1 minute and 5-minute charts. 1 minute and 5-minute charts are the most popular because most of the financial instruments that we're trading move relatively quickly. Some can move as much as 10 or 15% in a matter of minutes. And you might think, Ross, that's crazy. The average mutual fund doesn't return 10% in an entire year. And while you're right about that, what's also true about your average mutual fund is that they're invested in hundreds of different stocks in order to diversify their risk. But out of those hundreds of stocks on any given day, there's probably one of them that's bucking the trend of the overall market and is doing something exciting, perhaps going up 50 or even 100% on the day because they have great news. Now, the average of the entire mutual fund may not be affected by the one stock that's moving up, but as active traders, that one stock, that's the one that we're going to be watching. That's the one that's volatile, and in volatility is opportunity, certainly for those of us who want to be day trading. Okay, so when we look at a candlestick chart pattern, the first thing that I want you to understand is that the shape of these candles is communicating some real sentiment. So let's start with some green candles here. If we see a candle that looks like this, what would you think? Let's say this is $4 and this is $4.80. Wow, the stock just went up 20%. It opened at the very bottom. It never went down. If it had gone down, it would have a lower candle wick, but it doesn't even have a lower candle wick. It just went straight up and it closed at the very top. This is as good as it gets. This is the strongest candle you could possibly see. Now, whether this is $4 to $4.80 or $4 to $12, the size of how tall it is certainly can make a big difference. But this is called a long body candle. So we say long body candle. All right, it's a long body candle. It's a stock that's basically gone straight up. This is very bullish. Now, long body candles communicate very strong sentiment. Essentially, no matter where they occur, they're showing that there are either a lot of buyers or a lot of sellers. There's really no context where a long body candle is not communicating some serious market sentiment. However, when we're talking about variations of these candles, it's important to understand whether they're occurring when the stock is going sideways or whether the stock is trending up. So one of the things that's important to understand is that as an active trader, we're trading and wanting to trade trending markets. We don't make money if we buy a stock at 12 and sell it an hour later at 12. We want to buy a stock at 12 and sell it at 15. We want to trade stocks that are moving and preferably moving quickly. So I'm not going to be interested in trading range-bound sideways stocks. But something that's important for you to understand is that when a stock is going sideways, you may initially have long body candles as it's moving up, and then you might have a red candle, a couple red candles. And then when you get into this area where it's just sort of going sideways, more or less, obviously these would be red and green, the candles in this area do not communicate as much information. And the reason is because the very fact that the stock is going sideways is already communicating that there's sort of indifference. There's just sort of a balance between buyers and sellers. There's not really strong sentiment. So although there are some very specific candlestick patterns and candlestick shapes that I'm going to show you, these are most significant when they occur in the context of a trending stock. So I am only trading things that are trending. Trending means moving higher. Okay, so in the context of something that is moving higher, if, for instance, we have two really big long body candles. These are long body candles. You already know that. These communicate very strong market sentiment. Now, let's say the next candle does something different. I'll give you a couple choices. There's a couple different things that this candle could do. So the first thing that it could do is the price could open. It squeezes up, but it is unable to hold that level. And although it closes green, it ends up pulling back a little bit before it closes. Now, I filled in the body of that candle, but that was just, you could fill in these ones too. This is a very specific candle, and it's called a shooting star. A shooting star, well, shooting stars come back to Earth, right? They come flying down like that. And when you see a shooting star, it's named a shooting star to communicate so you understand this shape means something very likely is going to happen, which is a decline. The price is going to decline. This shape combined with the name is a communication of market sentiment. We see that the price has moved higher, but got pushed back down. Now, this candle could also be red. And if it is red, it's only a stronger communication that a reversal is coming. The reversal, in fact, has already begun if the candle closes red. If the candle closes green, it's an indicator that we're probably going to get a reversal, but it's not a guarantee until a candle actually goes red and shows that weakness. So a shooting star in the context of a trending stock is an indicator of a potential reversal. So if you were in a trade, for instance, you got in down here, you saw the stock, you got in at a great price, and it goes higher and higher and higher and higher, and then you start seeing this candle forming. Your brain should be telling you, wait a second, I need to be cautious. This is a shooting star. Shooting stars often come just before a reversal. And what's often true is that when we see back down here like this is the opposite of a shooting star. This also indicates a reversal. So a shooting star is when a stock is moving up, 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 and then you have the long upper body. The long upper candle wick. This right here is called a hammer. If you want, you could call it an inverted shooting star, and some people do, but I don't think that that's a good name for it. The name hammer communicates a message. Just like shooting star communicates the price is going to decline, hammer is communicating that we're hammering out the base. We're hammering out support. The stock is holding at the low of the pullback. All right. So this level down here, the low of this pullback, is becoming support. The price declined, but it bounced up off of it. This is an indicator again of a possible reversal. So this is true when the price has been declining. And it's true whether the price has been declining for, 15 candles. It's just been going lower and lower and lower. Just imagine those are all full long body candles. And then you have a hammer right down here. When you have a hammer right down here, the inverted shooting star, this is an indicator of a possible reversal. And we get a really nice move back up. So if you were in this to the short side, or you were looking for that reversal, the bounce off the low, this is the candle you'd be waiting to see. When I see this candle, especially after a string of consecutive red candles, I am almost always a buyer. Okay. Now, in this context, this was a little bit different because we're really in a stock that is in a position where the stock is definitely trending higher. This is just a short-term correction. But one of the things that I think it's important to understand is that price rarely goes straight up. Price goes in waves. It goes up and then it pulls back a little. And it goes up and it pulls back a little. It goes up because buyers are eager, they like the stock, and maybe there are some short sellers who have a negative position and they need to cover it for a loss. That short squeeze effect is what happened during the GameStop saga in 2021. So as the stock is making its first leg up, it's moving higher, and then it starts to roll over and pull back. Why does that happen? Well, if we look just on the chart here, the reason this can happen is because up at these prices up here, it no longer makes sense really to be a buyer, because when we buy stocks, we want to buy knowing where our max loss is. And we figure out our max loss using technical analysis and using candlestick chart patterns. And I usually set my max loss at the low of the previous wave. So if we're looking at a chart and it's just a bunch of really big green candles, then we know that our max loss is somewhere way down there. We might not even be able to see it. So that means it no longer really makes sense to buy it right up here. That's not a safe entry when your max loss is down here. Okay? We want to be able to better position risk and reward so that I'm risking $1 to make $2. That's a good risk to reward ratio. $1 for $2. All right? 2 to 1. All right, so when we get this pullback here, what's happening is buyers no longer felt confident getting in here, and short sellers began to think, this is extended. I'm going to sell it and hope it declines in value so I can buy back those shares at a lower price. And you get a momentary decline. But what ends up happening is if the stock has a news catalyst, if it's truly strong, that first pullback will get bought up and we will see the next wave higher. Because traders who missed the first move are looking at it and they're like, wow, this is a strong stock. I can still get in it very early. And now I can manage my risk based on the low of this pullback here, which means this becomes the new stop loss. And that's where this becomes your entry, the first candle. I call it candle over candle. So a candle over candle happens right here. When you have one candle and then the next one crosses over the high of that previous candle, it's called a candle over candle pattern. And so you may often hear me say, I'm going to buy the first candle to make a new high. These candles made lows, new low, new low, new low, relative to the previous candle. New low, new low, new low. So the first candle that makes a new high, boom, right there, I buy on this candle. This pattern is telling me to buy right here as soon as the price crosses the high of the previous candle. I'm in. All right, so I'm in right there, and I want to see that candle squeeze back up. My stop loss is the low of the pullback. My profit target is a retest to the high a day. And of course, I'd like to see it go higher. Now,